All right. Hey, everyone. I think we're going to go ahead and get started, and I'm sure there'll be a few more folks filtering in over the next couple minutes. But in the interest of time, let's go ahead and jump right into it. So, first things first, thanks for joining the webinar today. It's nice to have you. We look forward to a good presentation discussion and your questions at the end. So my name is Nathan Miller. I'm a director in E3's Asset Valuation and Markets Group, and I lead our market price forecasts across North America. There's a lot going on in today's energy industry, and the cone of uncertainty is perhaps wider than it's been in 2 decades or even more. But in the midst of such uncertainty, I think we believe here at E3 that fundamentals matter, and tracking fundamental cause and effect relationships is really critically important these days to separate the signal from the noise and create realistic market expectations that you can plan systems and procurements and investments around. So let's go ahead and dive into the next slide. I wanted to cover a few housekeeping items for the webinar today. So first, as you may notice, all attendees have been placed in listen-only mode. If you have questions, please use the Q&A log chat to type them into the chat box, and we'll be taking questions at the end. We may not be able to cover every question in the webinar today, and we'll do our best to follow up with individuals as we can afterwards. Also, if you have any questions you'd like to submit to us that are longer, more in-depth, or questions about the products that we're talking about, our forecasts, please send them to marketprices@e3.com. And we'll also be able to share a copy of the slides from today's presentation if you wish. All right, so let's launch into it. The next slide, please, Tristan. So first, I just want to give everyone a quick primer in case you're not familiar with us. Who is E3? Who am I? Why are we here talking about market price forecasts? So E3 is a data-driven technical consulting firm. We specialize in the electricity sector. We've been focused on the energy transition and electricity sector modeling for over 30 years. We have about 130 consultants across 5 offices in the United States and Canada, San Francisco, New York, Boston, Calgary, and Denver. Each year, we complete a little over 300 projects. We have a very diverse base of clients, starting off with one group of our commercial clients, investors, developers, and asset owners, and then utilities and system operators, and then public sector agencies, policymakers, regulators, as well as nonprofit organizations and stakeholders in the space. Now, our diverse client base really covers a 360-degree perspective on the energy industry. And we believe that it's really critical to get these different stakeholder perspectives that also really inform our market outlooks, tracking our insights that we're picking up, and talking with real folks, answering questions, for their businesses, for their key concerns between buyers and sellers, customers and utilities, generators, policymakers, and regulators. Let's go to the next slide. So we've organized ourselves into 3 major practice areas. There's asset valuation in markets, where Tristan and I sit. There's integrated system planning, and then climate pathways and electrification. The thesis here is that we're covering the spectrum of key issues and questions in the energy industry, from the policy kind of top-down level all the way to commercial interests and transactions and almost the bottom-up level, and where there's meat in the middle. So our climate pathways and electrification practice works on key questions of decarbonization pathways and wedges across sectors. How do we get to that decarbonized future? Industry, transport, and electric sector transformations, and what's happening. How do we model and understand the evolving electric loads coming in from EVs, buildings, and also large customers? Then our integrated system planning practice supports electric utilities and system operators with that short and long-term resource planning of, okay, given these fundamental changes, how and our policy targets, decarbonization needs, reliability needs, how do we build out resources in different systems to meet those needs over time? We also do a lot of reliability modeling, including capacity value, and working with effective load carrying capability expectations and forecasts, which is the capacity accreditation and value of renewables, storage, as well as conventional thermal resources. And then finally, our asset valuation and markets practice, we provide market and strategic advisory services. from the market price forecast we'll be talking about today, but to also including asset revenue projections, transaction due diligence, and market entry strategy for developers and technology providers. We support large and small capital providers, private equity, debt, tax equity, as well as developers and asset owners with bankable, realistic views across markets and across asset classes. And these are informed by insights across all of our practice areas, as I mentioned. So at this point, enough of me. I'll turn it over to Tristan, and he'll dive into what we're seeing in Eastern markets.
Great. Well, thanks, Nate. I appreciate it. So let's move on. To talk about the Eastern Interconnect and some major themes. So the Eastern Interconnect covers large swaths of US and Canada. It's been called one of the largest machines in the world, which is truly an incredible feat of engineering. And for our forecast here at E3, we model the entire Eastern Interconnect, from Miami all the way up to Atlantic, Canada, and over to Eastern Montana. But E3 specifically publishes forecast for the 5 wholesale electricity markets in the US and the East. So ISO New England, New York ISO, PJM, SPP, and MISO. We also have avoided costs forecast for specific utilities in the Southeast that's available upon request. But stepping back, there are 4 major themes that I see across this footprint. And these 3 themes are seen both in the historical data and the forecast. And where each region or zone falls within these themes really dictates its outcome. And these themes are load growth, which has historically been defined by energy efficiency, but we see that forward expectations will be impacted by electrification and large loads in data centers. Next is policy. Now, federal policy has certainly been impactful, whether it's EPA regulations or tax credits for specific generating resources. But the regions differ through state policy, both renewable portfolio standards and other decarbonization goals, as well as carbon pricing. And the third one is what I'll call resource endowment. And this covers both proximity and access to low-cost natural gas. I can remember what it feels like not too long ago that $5 gas seemed cheap and sub $2 gas was unthinkable. However, access to this low-cost natural gas is not uniform. Also, the relative resource potential of wind and solar also impacts development and forecasted price streams. And the final theme is the retirement of baseload resources, primarily nuclear and coal, which have had major impacts on markets. And how those retirements continue or maybe get delayed will also have key bearings on the forecast. But overall, E3 sees the intersection of these themes leading to a broad challenge. And that is, how can these systems decarbonize and integrate a larger share of intermittent resources while meeting increasing load growth and maintaining reliability? All right, so on the next slide, now something I just want to quickly highlight and to give some context for some later slides. E3 really sees our market price forecasts as having a symbiotic relationship with the rest of our work. And I won't go into all of them here, but they span the practice areas across E3. And I want to note that E3's project work is both leveraged to inform E3's forecasts, as well as uses E3's forecasts in the project. So it's a two-way street. All right, so moving on, before we get into some price streams, let's talk about some inputs. And then before that, I'm going to talk about our forecasting approach. It's a little bit about that. Now, here's a slide. Now, I admit it's quite busy, but explains the process that E3 goes through to develop our price forecasts. Starting in the top left, we leverage E3 analyses and tools across the firm. Nate mentioned a little bit of this earlier, but we use the results of pathways projects, which show us how different regions will meet their decarbonization goals, and also informs our views on electrification-driven load growth. We use Reshape to inform the hourly profile of electrification, both buildings and electric vehicles. We use Recost, which I'll discuss more later, to inform our views on new resource costs, which has a direct impact on results of capacity expansion and capacity and rec price forecasts. We leverage Recap, which is a stochastic reliability model that informs our expectations for ELCCs, which also has an impact on new builds and capacity and rec price forecasts. Then moving to the right are various key variables that go into our forecasts: load, policy requirements such as RPS, transmission development, new resource costs, and fuel prices. Then from those inputs, we perform capacity expansion analysis to determine new builds and retirements, and then detailed production cost simulation of the day-ahead energy market using PLEXOS. And this provides us with the output generation, transmission flows, and energy prices. And then on the far left are all the final price streams and other outputs that we generate. So that's day-ahead and real-time prices, which do require some post-processing after PLEXOS, capacity prices, REC prices, prices in the ancillary service market, so spin, non-spin, regulation, and ELCCs and system operations. So that's a little bit about our process and everything that goes into it. And the last thing I'll say is that this is all produced at the zonal level, but we do have capabilities to produce nodal price forecasts as well, and often perform those analyses for clients when they're concerned about nodal basis risk for their specific project. All right, so moving on, let's discuss some of the primary forecast drivers. And first is demand. And let's start here with historical demand. Now this chart here shows the growth, or really lack thereof, in electricity demand since 2014 by each eastern region. And maybe somewhat surprisingly, most all regions have seen flat to declining demand over the past decade. This is primarily due to energy efficiency, but also from the pandemic. Moving on, the next slide is E3's forecasted demand. And you can see that these forecasts are a departure from history. And the story is, varies across regions. In the Northeast, we see electrification, primarily building electrification, but also EVs to a lesser extent, are driving higher power demand expectations. Whereas in PJM, for example, where Northern Virginia is home to the most data center capacity in the world, we see large expected growth, especially over the next decade. And lastly, I'll note that these expectations are part of E3's 2024 forecast. Given the change in administration and the key policy developments that have already occurred, we are actively working on our 2025 forecast, which will be available in the next 2 to 3 months. And I'll say that we do expect EV load growth to slow under the new administration, driven by an expected decline in tax incentives and less support for charging infrastructure. All right, so moving on to the next slide, I wanted to highlight a study that E3 just completed in December with the Virginia Joint Legislative Audit and Review Committee, also known as JLARC, where E3 explored the generation mix impacts from high amounts of new data centers. Now, this report's publicly available, and we can share some links following this webinar. But in this study, we found that if unconstrained, this could require over 30 gigawatts of new renewables, 15 gigawatts of new fossil fire capacity, and 3 gigawatts of new nuclear storage and transmission capacity, all over the next 15 years, which is just truly unprecedented growth. And I also wanted to highlight a past study E3 performed on New England economy-wide decarbonization. In this project, we used E3's Pathways model, and it went a long way in informing our electrification expectations across the region. And again, this report is also publicly available. So overall, I just want to highlight these two projects help shape E3's expectations for power demand growth in specific regions in the Eastern Interconnect. Okay, so the next slide is on state energy policy. Now, I won't go through all the states listed here, which it lists its renewable and clean energy targets, but just a few notes. First, the Northeast, New York and New England, have the most stringent targets, while further west, PJM and MISO had the most varied targets from state to state, and SPP really lacks any binding targets. And this all results in varied expectations for electrification as well as policy driven. So, outside of pure economics, for example, growth of renewables and storage. And last thing I'll say is that E3 does not expect meaningful changes to these targets as a result of the new Trump administration. But we do expect, and especially if the tax credits from the Inflation Reduction Act are ultimately repealed, that the cost to meet these targets will increase. On this next slide, I want to highlight a study that E3 did for the state of New York, specifically NYISO, who leads the state's renewable procurement, among other things, looking at how the state can meet its requirements under the state's Climate Leadership and Community Protection Act, or also known as the CLCPA. E3 analyzed various pathways, and here shown as scenarios, to meet the targets, analyzing both the power sector as well as the broader economy to determine the impact on electrification. And this is just an example of E3 performing policy analysis in the region, utilizing our tools and helping to inform our market price forecast. Okay, so moving on to the next slide is gas prices. Now, gas prices are obviously, a key driver of wholesale electricity prices. What this slide shows are key gas hubs across the 5 eastern markets. And what I wanted to highlight here are their higher prices in winter. What I've shown are average January prices this decade. Higher prices in the winter in the Northeast, primarily New York, New England, and Eastern PJM. And this difference in prices is primarily due to proximity to and pipeline interconnection with major shale gas plays. Although New York and New England are geographically close to natural gas production occurring in the Marcellus, pipeline constraints and gas demand lead to higher winter gas prices. Overall, these higher winter gas prices have key bearings on price formation in that time period. And E3 expects this trend to continue and could be exacerbated by a switch to winter peaking, given higher load from building electrification, which we do expect to occur in our outlook in New England and New York. But also there's potential for regional hydrogen adoption in place of gas that could further the overall fuel price premiums for Northeast regions. Overall, E3 expects minimal impact from the new Trump administration on this, given long lead times for pipeline development that go beyond a presidential term. Okay, so sticking with resource endowment, in this next slide, I want to quickly highlight the renewable resource endowment. First is that although we do expect a lot of solar build in the East, the resource potential is much better in WEC and ERCOT. Also, most of the best resources for wind are concentrated in MISO and SPP, while New England, New York, and coastal PJM do have strong offshore wind resources. So just highlighting this has key bearings on where resources are built. Okay, so the next slide here is on base load retirements. On the left is nuclear capacity, and on the right is coal capacity going back to the year 2000, again, across these 5 eastern regions. And what you can see is that some nuclear retirements have occurred, about 8 gigawatts since 2013, but 77 gigawatts of coal retirements have occurred, and the majority in PJM and MISO. Now, overall, both baseload resources have been under pressure from both low-cost natural gas and more renewables, both of which put downward pressure on energy prices and reduce energy margins. But coal has also been under pressure from a whole host of environmental regulations as well. For example, the MATS rule, mercury and air toxics, drove a lot of retirements in the mid-2010s. And I should also note that coal has been under pressure for lower utilization due to coal to gas switching. Looking forward, E3 expects retirements to continue, but now perhaps see some delays. First, nuclear is seeing a boost from increased demand from new data center load expectations, which matches its generation profile. And coal retirements are likely to be delayed for low growth as well, but also an easing of environmental regulations under the Trump administration. One of which is from coal ash, but longer term from policy under Section 111D of the Clean Air Act, which regulates existing power plant carbon emissions, which we expect to be rolled back. Okay, so moving on, the next slide is a glimpse of capacity and generation expectations for these 5 regions in the East. And what is shown here is the breakdown by fuel for each ISO comparing 2023, which is the last full year of actuals, and E3's expectations for 2035. Now, first, you can just see the sheer magnitude of capacity, which is on the left, that is expected to be added. But I wanted to note that given the lower capacity factor of wind and solar, generation is not nearly increasing as much. Also, E3 still expects, given continued retirement of baseload resources, primarily coal, and load growth from electrification and load and large loads and data centers, E3 expects gas to still be needed for reliability. And I mentioned the impact from the new Trump administration on coal retirements in the last slide, but another impact will be on offshore wind. The administration will be challenging wind broadly where it touches federal leasing or permitting. And in the East, E3 sees offshore wind, which relies on federal leasing and permitting, to be the most impacted. Okay, so that's a bit about our capacity and generation expectations. Now, in the next slide, I wanted to highlight quickly E3's recost model, which is also a product that is available for purchase for the forecast. Recost is a discounted cash flow model that is used to calculate levelized costs of new builds across resource types, both traditional generating resources and emerging technologies, as well as across geographies. It is used to inform expectations on what will get built, when, and where, as well as to value these resources for PPA contracting. The forecasts rely heavily on publicly sourced data, but also E3's decades of experience in electricity market costs. Okay, so that wraps up our section on the primary forecast drivers. Now let's get into the prices themselves. Okay, so first here, for some context, are historical day-ahead energy prices across select zones in each of the eastern markets. Also included are Henry Hub gas prices that are shown as the thick black line and are on the right axis. Now, a couple of things I want to point out. First, the energy prices show a strong correlation with gas prices. Gas generators still set the marginal price the majority of hours across markets, and E3 doesn't expect that trend to lessen to an extent. We expect it to lessen, but mostly remain true throughout the outlook. And second, given the larger baseload fleets of SPP and MISO, they are often at a discount to prices in the other ISOs. Okay, so moving on, the next slide are historical daily shapes. Now, what these charts show are the average prices across the year in that zone in that hour. And the data is shown for 2015, 2019, and 2024. So what these charts generally show is that in 2019 prices increased and then back down in 2024, mostly driven by gas prices. In most markets over time saw an increasing duck curve shape become more pronounced with both higher load, but also higher solar penetration. The exception to this is SPP, which has lower gas prices and a heavier wind and baseload portfolio. On the next slide is a look at forecasted prices. Now this still shows the historical prices I showed earlier, but now with the addition of forecasted monthly prices in 2035. What you can see is that prices continue to be strongly correlated with gas prices. In New York and New England, prices continue to be at a premium. And the next slide shows average daily shapes, including 2035 for the forecast. In the Northeast, driven by higher gas prices, prices in the nighttime hours are higher, while daytime hours see less of an impact from increased solar penetration. Overall, the morning and evening ramp sees a starker contrast than historically, more of the duck curve shape. All right, so let's move on to talk about capacity prices. At a high level, capacity prices are designed to provide make-whole payments to either incentivize new generating capacity to come online or to keep existing resources from retiring. And as you can see here, prices have varied across time and by market, but generally have been in the $1 to $5 per kilowatt month range. But it's important to note that capacity programs details vary, which can greatly impact the price. The markets are often split up into different zones, which can impact clearing prices. And they also vary in how far ahead they clear. PJM in New England, for example, are intended to clear 3 years ahead, while New York is month ahead. And MISO is different still, as it is for the upcoming year, but is more of a residual market where most capacity in the region clears bilaterally. Also important to the fundamentals is that each market is at different stages of exploring and implementing capacity accreditation, which will have key bearings on how the market fundamentals evolve. And I'll speak a little more on that later. So that's a bit about the historical prices. Moving on, the next slide is a preview of E3's forecasted capacity prices shown for 2035 at the end. Battery storage additions are expected to temper price growth in New England by 2035, while demand growth is not expected to be impactful on capacity prices until after 2035. In PJM, there's really a confluence of factors leading to higher prices, including thermal retirements, high demand growth driven by data centers in the near term and electrification longer term, as well as capacity accreditation that will decline over time for renewables and storage, and also lead to a derating for much of the thermal fleet. For New York, electrification-driven load growth and thermal retirements will put upward pressure on prices. So moving on to the next slide, I want to highlight E3's experience performing resource adequacy analysis. Now, I mentioned this earlier, but E3 has a tool called RECAP, and it's a stochastic loss of load model that uses time sequential dispatch for capturing the availability of intermittent and energy limited resources, notably wind, solar, battery storage, and hydro. And we have used it with utilities and market operators across North America to study resource adequacy. And these entities are shown on the map here. E3 has also worked with system operators on market design around capacity accreditation, specifically PJM and MISO in the East, to inform the methodology of their ELCC forecast, as well as independent power producers on capacity market issues. Now, this knowledge of resource adequacy broadly and capacity accreditation specifically allows us to directly inform our market price forecasts and modeling assumptions that are so essential to capacity expansion expectations and capacity prices. Okay, so let's move on to the last price stream we're going to discuss today, and that is REC prices. Similar to capacity prices, REC prices are designed to provide make-whole payments to incentivize new renewables to come online, but in this sense to meet state renewable energy targets. Generally, prices for RECs, at least those for stringent state policies, fall within the $20 to $40 a megawatt hour range. But that price can be heavily informed by the specifics of the state renewable energy program, which can differ in what resource types are covered, what the target is and by what time period, and if there are any built-in price containment mechanisms. Overall prices are informed by electricity demand as well as the price of other revenue sources such as energy and capacity, as well as new resource costs. And the next slide shows a snapshot of 2035 REC prices across the three markets. You can see that the prices are declining somewhat, and this is driven by a large build out of renewables, but also rising energy and capacity prices, as well as declining costs of new renewable resources. All of these factors combine, increasing revenue from other streams, declining costs, to put downward pressure on REC prices in these eastern markets. Okay, so just to summarize, here's where we see some of the primary price streams in the eastern markets evolving to by 2035. Annual energy prices are expected to continue to rise in nominal terms and will stay correlated with gas prices. The shape of those prices will change, and higher demand and gas prices push up non-solar hours, but solar penetration will act to limit escalation of prices in solar generating hours. Capacity prices are generally expected to rise with retirements and load growth, as well as declines in capacity accreditation over time from renewables and storage as their penetrations increase. And for REC prices, we see a general softening driven by higher energy and capacity prices and lower costs of new renewables. Okay, so I want to wrap up this section by showing a couple of projects that leveraged our market price forecast. And the first here is a due diligence project with Blackstone, where they ended up successfully purchasing a minority stake in NIPSCO, which is a gas and electric utility in northern Indiana. The market price forecasts were essential in being able to effectively analyze the utility and understand its fundamental value, as well as think through scenarios of how that value could evolve under different market and policy conditions. And next is the New Jersey Energy Master Plan. E3 supported the New Jersey BPU on the creation of the report, which explores the state's energy use and management of energy, as well as how its 2035 clean energy target can be achieved. E3's knowledge and expectations for the PJM market and surrounding markets was fundamental to being able to support the state in this capacity and help them plan for the future. Okay, so now I'll just move on to some concluding remarks. So to recap, E3 covers 5 wholesale markets in the East and provides pricing streams of day-ahead and real-time energy prices, ancillary service prices, and capacity and rec prices. We do consider these forecasts to be bankable and use them directly on dozens of transactions valued in the tens of billions of dollars. With the purchase of a market price forecast package, you get the price streams, but you also get a file on the assumptions used, as well as our market report slide deck. And of course, E3 staff are available to discuss the forecast as needed. If you have any questions or want to set up a time to discuss our offerings, you can reach us at marketprices@e3.com. And for more information about the forecasts, as well as purchasing them, you can go to e3.com/2024 forecasts, and there's a 10% discount, which is webinar 10 if you purchase by the end of the month. And with that, I'll kick it back over to my colleague, Nate, to start the Q&A portion of the webinar. Nate?
Thanks, Tristan. All right, so let's see, looking at some of the questions we have. One of the questions here is around nodal price forecasting. So that's definitely an important topic. We are engaged in this a lot in our commercial transaction work, either from the procurement and bid evaluation side of the equation, or from the developer individual project revenue expectations and financing. So nodal forecasting, we do provide nodal forecasts. We provide nodal forecasts that are essentially a downscaled product from our fundamental core case, which is at a zonal level within each of the market zones, transmission zones, as Tristan was describing. So the nodal forecast, we offer a few different levels of analysis. There is level 1 to 4 is how we've characterized them. Level 1 is a statistical analysis based on historical nodal basis, kind of projected forward against the hub curves that we have from our fundamental production cost model. Levels 2 and 3 provide an additional deeper dive in a particular region, analyzing expected fundamental changes to transmission, interconnection limits and upgrades, new renewable or other generation resources or loads in a particular area to inform how that historical basis shape should change over time. And then the level 4 is a nodal production cost simulation that will provide usually for snapshot years to inform kind of a really deep dive for folks looking at assets that have a very high exposure to a very volatile nodal dynamic. Let's see, we have another question here on custom cases. So obviously, as Tristan explained, all of our forecasts, they come with a fundamental assumptions book that has kind of everything from loads by zone and generation additions, capacity and generation mix, megawatts and gigawatt hours, as well as kind of our gas and carbon prices, and resource costs that underpin the cases and the market outlook. We can vary, any or all of those factors to run custom cases. We do that a lot for our clients, and we simply, price that in based on the incremental effort required, depending on the nature of the customization. So some of them, like changing a fuel price expectation, can be relatively quick, and other clients want to, dig really deep into changing technology assumptions or modeling new technologies that weren't considered in our kind of business as usual case, and that's all certainly work that we can perform and have done in the past. Let's see, we have another question on retail tariffs and rates. Yes, we do provide retail rate forecasts. We do this a lot, actually. We have a whole practice that is oriented towards behind the meter resources and distributed energy resource compensation schemes and tariffs in different jurisdictions, whether it's kind of a net metering or your Massachusetts smart or clean peak programs. We do provide all of those idiosyncratic forecasts, New York VETR, and that's something that we do, on a market by market basis, depending on what folks need. So please send us an email to marketprices@e3.com if nodal or retail work is something that you have an interest in or a need for. Oh, one more question here that I'm getting. Let's see, Trump administration actions and how that recent action, it's been a tumultuous January. I know we're all keeping our eye on the ball and sort of watching what's happening. So that's a good one. Let me give a quick voiceover there. So the forecast that we have off the shelf were finalized late last year. They reflect our best, latest and greatest estimate of putting all the fundamentals together in each market based on resource costs, fuel prices, load expectations, data centers, EVs, aggregate customer baseline loads, as well as, specific state policies. Certainly, some of the recent actions already in the early days of this administration have some impacts. The executive order around offshore wind and wind on federal lands, as Tristan mentioned, expected rollback to the Rule 111D of the Clean Air Act. Those we are certainly evaluating to see, how much they're going to stick, and then we'll be incorporating them into a modified kind of post-Trump, early day update in the next couple of months. So we do, look at the fundamentals of our existing cases that are available today off the shelf, and we do think that they represent very realistic expectations of trend lines, especially over the longer term. But we are certainly working actively on incorporating any updates that we think are impactful enough to warrant the additional production cost runs and an updated market price outlook in the coming couple months. So keep an eye out for that. If you have any more questions about that or have a near-term project need, feel free to reach out, and we're happy to talk more directly about what we're considering and where we see things going there. Let's see. Oh, we have a question about ancillary service prices. Yes, we do a lot. We didn't cover this actually here, so I'll take a minute to. We do a lot of battery revenue forecasting, a lot of battery revenue forecasting in CAISO and ERCOT, but actually across all markets, including the eastern markets from SPP and MISO to PJM and New York and New England. We have definitely supported. It's another question I have. NYSERDA's index storage credit forecasts. So, we understand that contract very well, and we actually did a storage roadmap for New York that informed some of their procurement decisions a few years ago. And so, I'll answer ancillary services and then talk about batteries in a minute. So, ancillary services, we have a machine learning model that has been put into production that essentially tracks and aligns with our previous regression-based analysis of the ancillary service price to energy price relationships in different markets by product, by specific AS product. And that model looks at historic relationships to opportunity cost-based bids between the current stack of generators providing ancillary services. And then we layer on top of that an expectation around how batteries, specifically with their penetration and the type of AS product requirements and opportunity cost pricing of batteries in each market, how they'll impact and drive down and saturate some of those AS prices over time. So it's essentially an ML model that is using historical data projected against our forecasted energy curves, taking into account our expectations of battery price saturation, some of which have already started to come true in California and Texas. Around the battery modeling for battery revenue models, we take our energy, AS, and real-time forecasts from our core market cases, and we run them through a battery optimization model. It's a price taker model called Restore. We can run different configurations of technical assumptions, degradation, round trip efficiency, long duration, short duration storage, co-located, paired assets, or independent sort of standalone storage, or behind the meter assets. All of those can be configured in the tool, and we've used there's revenue projections in everything from M&A transactions at the platform or portfolio level for capital raises, developer strategy, as well as tax equity transactions in those markets of late. Oh, a follow-up on the Trump tariff question, or the Trump policies. Do we see those tariffs impacting um, did various nodal prices as well as kind of resource costs? Um, It's a great question. So, in a very specific sense, obviously, anytime you tax an input into final production, or increase the price of imported goods, specifically battery modules, solar panels, electric infrastructure, cables, transformers, etc., that's going to have a requisite increase in the price of building those resources in the near term. Um, by itself, that is going to just sort of shock PPA prices, we expect. And some of that, pricing uncertainty has been sort of built in and is in the cone of uncertainty of just general panel prices as they've bounced around. Same with battery modules. But it will certainly be impactful to the pricing that developers have to, handle as a variable in their offers in various procurements. However, that there's going to be, of course, a secondary order impact where when you have an additional risk factor, an additional cost increase, that may have a knock-on effect of the quantity of megawatts, megawatt hours that are procured from those resources, the pace of development. We don't see that at the time being. I mean, I almost have to say this is on Tuesday the 12th or Wednesday the 12th. Things can change quickly. But the resources that are needed to meet load growth are still very real and fundamental. And even if they cost a bit more, that demand is here and demand needs to be met. So that is likely to have some impact on development timelines, and we'll be keeping a close eye on that. But we also don't see, as envisioned and implemented today so far, this to be a seismic disruption in the near-term electricity market expectation. Let's see. Coming up on our time here, we have, yes, another question around retiring baseload generation. So the very important question, as Tristan was talking about. So we certainly have projections by individual ISO, RTO, market region as to which specific resources are retiring. Those retirements are informed by an expectation, first of all, by the announced generation retirements by asset owners, and then a view of how those announcements, basically between generation that does not have any announced retirement date, but just has a likely end of life, and various policies that may accelerate retirement sort of faster than that stated end of life expectation. So we do include those very specific assumptions of coal and nuclear in particular from market to market, depending on those specific factors. I think right now what we're seeing happening with the load growth, especially in the PJM region, is that we are likely going to see coal retirements with the easing of Rule 111D from the Trump administration being somewhat delayed in some cases to support, in part, the data center load growth that is coming in. And certainly this is an evolving topic, so it's something that we're keeping a close eye on. Okay, I think that is rounding out the questions that we have received here. So I think with that, we can go ahead and wrap up. Again, just to voice over everyone who has registered for this webinar with your email, we'll be sending out a link to the recording. We'll also be sending out a copy of the slides in PDF form for you to review. And again, we thank you all for joining us. There's a lot going on, and we look forward to continuing this discussion with you in the days and weeks ahead. If you have any questions, again, please reach out to us either directly. Both Tristan and I are on the E3 website. You can send us directly emails, or you can send an email to marketprices@e3.com, and we'll be happy to talk with you further. All right. Well, thanks, everyone.